Hi, I'm Debra from the Property Frontline.
Hi, I'm Ken from Avvora Finance.
And I'm Gilmovich from Real Property Manager. And welcome to Property Mythbusters. Good to have you back. And Property Mythbusters are here to bust some myths around the property buying and property investing landscape. And it is a jungle out there right now. And we're here to...
It always is, John.
It always is. It is a jungle. And we're here today discussing the myth of whether you shouldn't buy in this current pandemic COVID-19 affected property market. So let's take a look, guys. Let's take a look at this. What came across my desk is a recent survey, which I want to just bring online, which was done by an organisation called PIPA, which is the Property Investors Professionals of Australia. So they're all the buyers agents, generally, the property sources who are on the ground purchasing properties on behalf of home buyers and investors. And they recently did a survey. We're just going to have a look right now what came out of that. I'll just bring it up on screen. Here it is here. So generally a market survey entails about 1,000 surveyed people or members or organisations, and they've done just under 2,000 there. Which were mainly along the East Coast, New South Wales, Victoria and Queensland. And you can see the age group demographics there, the splits there, and of course the personal incomes or household incomes of those respondents. So this survey was really about how everyone feels about this current marketplace, and whether or not they would or they wouldn't go in and make a purchase. So what came out of that, there's a couple of results here. Firstly, investors, looking at investors here, 70% of respondents are saying now is a good time. Now is a good time to purchase. Around about 72% of respondents who are investors were generally confident in the market's short-term projections. I mean, to me, short-term could be anywhere 12 to 18 months or a little bit beyond that. And 36% saying that they have experienced some loss of income during the pandemic, and that 91% had not paused their mortgage. So there is some good cash flow still coming through, where there's their own rental properties, they have other sources of income, other investments, or they have another business, or they're running businesses, and the income's still coming through. 30% said they were less likely to sell over this period, and 63% indicating no change at all. Now, generally speaking, in a pandemic where people are frightened or hesitant to make a move, there's of course uncertainty in the marketplace. The majority are not going to make a move. They will be the fence sitters. They'll be undecided, and they're not going to make any big financial decisions generally. Okay, so it's the very brave, the very prepared, and the ones seeking opportunities right now in this kind of market where the majority are spooked, will pounce and will make a move. And this came out very, very strongly in the survey, that they will take advantage of this marketplace if they're ready and prepared and cashed up and have the risk element. Okay, so you've got to You got to have a stronger or above average risk tolerance to go into this marketplace, but it's certainly a marketplace of opportunities because the majority have backed off out of the market. So if you're a home buyer, as an example, and you've been competing for the last 7 or 8 years with the investors, which we know, some of the activities at the auctions, the big fat checkbooks have been with the investors, and the home buyers, and especially the first home buyers, have had a very, very small chance of competing against the investors who generally have succeeded in those property purchases at a competitive level. So to me, this is an opportunistic time, despite uncertainties. Generally speaking, the marketplace is stable at the moment, or most marketplaces are stable, and we really haven't seen much significant drops in property prices. And Deborah, of course, you'll show some stats around that shortly. But right now, if you're in a position to make a move, and I've seen some of my own tenants come out of the rental market and take opportunity of this marketplace and go and purchase their first home, especially families that have been paying, those big inner city rents of over $1,000 a week. They're definitely taking advantage of the low interest rates right now, have been saving for a while their first deposits, and are definitely making a move out of the rental market and into their first home. So on the ground, I'm seeing a lot of that going on. So I can see the confidence of those people who are brave enough to get in right now into the market.
Yeah.
What do you think, Ken?
Yeah, look, that probably makes a lot of sense, John, like you mentioning renters moving into the purchasing side of things, because I think interest rates are exceptionally low compared to historically over the last decade or so. And it's actually quite interesting. So there seems to be a lot of inquiries for purchasing homes as opposed to investments at the moment. Could be due to the uncertainty around the return on investment or rental yields and things like that, making the decision, skewing it to be not feasible. But in any case, what I'm kind of seeing is with interest rates decreasing, borrowing capacities tend to increase because the interest is low. When they kind of work out whether you can make those repayments, if the interest rates kept falling down to zero, you can pretty much, within a 30-year loan term, low interest rates, you can technically borrow more. What we're seeing now is some lenders really focusing on the debt to income ratio, which generally sits at around about 6. So they don't want to see your income, whether it comes from salary, like self-employed, rental income, things like that. The total amount they don't want to see you borrow is, or in terms of your total debt, home loans and everything, more than 6 times your income. So it's, some of my clients are seeing that potentially cap their borrowing capacity. And it's something to factor in, I guess, when you're looking at applying for a home loan. Just because your borrowing capacity says 800. And what normally happens is if you go above this threshold of 6, so for every dollar you earn, you're borrowing $6. The lenders take a more conservative approach by requesting the LVR be lower than a certain point, or sometimes they straight out, require a bit of risk mitigation, meaning that they'll need to feel comfortable if there's strengths to the application. So if, you're borrowing over 6, the ratio of 6, they might want to see very strong cash flow. So they know that, regardless of what happens to the security or the property, you're able to make those repayments. That's something that's coming in as interest rates, I wouldn't say they're falling still, but they're kind of hovering around about, anywhere between around the 2s. So that's something to consider when you're looking to borrow and purchase a property. Is there anything, what's happening over at in your end? Yeah.
Okay, yeah, I completely see the same sorts of things that you two are seeing. So in relation to the actual myth of whether you the myth that you shouldn't buy in the current market, of course, what we're always saying to our clients is that you should never use the market to make decisions about whether to buy or not to buy. Often people get confused and they'll sit on the sidelines waiting for the market to be perfect, and that's where they either miss out or make the wrong choice. What you need to do is to look at your own personal situation. So are you in stable employment? What's your what are your personal drivers? And I'm talking to a lot of people who were diligently saving up these huge deposits, and now all of a sudden they've got lots of grants and lots of state and federal government support, and their position has changed very, very quickly. So look at your own situation. If the time is right for you and your personal requirements match, moving ahead for a purchase, then what you need to do is use the market information to decide what to buy, not whether you should buy or not. So along those lines, I'll just show you. And this will be interesting because I've got to change the screen and share my screen. And now I have to try and move this out of the way so I can use it. As John was saying, the current situation is better for home buyers because they don't have to compete with really bullish investors. And John was telling us a story just prior to this where he had attended an auction and had seen an investor pull out an extra 100,000 on the offer price just to smash everybody else out of the water. So we're not seeing that kind of activity at the moment, which is great. And at the moment, you'd say that the market is quite stable. So it's not really ramping up in price, and nor is it totally dipping. And so you can see this is
only thing dipping are the rents at the moment, as we can see. Okay, so the rents are being shaved off a bit. And of course, what that means is that the investors are backing off because the yields aren't terrific. Yeah, it's harder to hold the property, and it costs you more if you haven't got that cash flow to support. So the investors are backed off. Yeah. And as we know, Deborah, around Australia is generally a home buyer's market. It's not an investor's market. It's about 70-30 towards a home buyer. Yeah. Or in some states.
So looking at prices at the moment, the interesting thing here, this is data that was prepared by CoreLogic. So they're the company that gets all of the data from the state, from the state sales stats, and they compile it all into information that the RBA uses to make their decisions. Now, so in Sydney, you can see that there was a big dip in towards June last year, and then the market recovered. Melbourne, a fairly similar kind of trend, though month on month, they have really got a bit of a dip in June. Brisbane, had a real uplift early this year, and so it's really at a pivot point. We're seeing it flatline. Because I'm actually buying at the moment, we are seeing good quality property flatline. Where we're actually seeing an overall market dip is all of those, off the plan and unit prices where they're starting to see a few discounts, which will have the market trending down. Then in Adelaide, quite stable. Perth starting to come out of a major decline, and Hobart sort of in a bit of a holding pattern. So really it shows that it is a fairly good time for home buyers in that they won't have to compete with investors. But I'm also seeing a lot of renovators who are in the exact same position as home buyers, where the renovators were bounced out or priced out of the market by big spending investors. And so I'm working with quite a few renovators who are looking at grabbing a few opportunities now, and they'll be in a position to time themselves as to when they're either going to sell their properties or split and continue to build, so they'll retain their properties over the next couple of years. I think it's also good for commercial buyers. There's quite a few opportunities at the moment, and we are seeing a few people who are looking to snavel up a few bargains. So where they've been renting their own commercial space, there's a lot more people starting to look at transitioning into purchasing that as well. But that's pretty much it for me. Ken, did you want to wrap up?
Yeah, sure, I will. So yeah, I hope you found all that, I guess, insights in terms of what's happening in a property management space, the property market, and also the credit space as well. Thanks for watching. We'd love to receive your feedback. And you can also, so please join the Property Mythbusters group. Send us questions and myths that you might like busted, that you're hearing out there in the marketplace. You can also contact us directly through either our social media channels, websites, or our email addresses. So you can contact Debra at debra@propertyfrontline.com.au, John at realpropertymanager.com.au, or myself, Ken H at avvora.com.au. So that's the episode for this fortnight.
Okay, bye.
Bye.